Hi, I'm Joe Seidel, investment strategist at Blackstone, and welcome to our Q3 webinar, The Market Implications of Global Disarray. I'm joined, of course, by Byron Wien, Vice Chairman, Private Wealth Solutions and Investment Strategist. Welcome, Byron.
Well, it's good to be here with you, Joe.
Thanks. Over the course of the next 60 minutes, Byron and I will take you through our views for global markets in the third quarter, focusing on some of the risks and opportunities from faster growth, inflation, but also concerns about trade. And we'll also leave plenty of time for your questions, which have been collected from social media. With that, thank you for joining us. Byron, before we get started, I would ask you to share with everyone why the title Global Disarray. We went through a lot of different iterations before settling on this title, but from a high level, why this tone now?
I think the reason we settled on this title is that the market keeps going up almost every day. And it does that in spite of the fact that a number of international agreements have been abandoned or at least withdrawn from, and that there's general conflict, Republicans against Republicans, Democrats against Democrats, and of course Democrats against Republicans. Also, around the world, the United States has pulled out of the Iran agreement. We didn't sign up for the Paris Climate Accords. There was a meeting with North Korea to head off a possible nuclear strike against Seoul, Tokyo, or even Los Angeles. So there's a lot going on in the world that you would think would be unsettling, and yet the market makes a new high. What we think is that we're going to end the year with the S&P at 3,000. It's about 2,800 now. But it's going to do that in spite of all these negatives that are afflicting it. And my feeling is that there's going to be a setback somewhere along the way, but we haven't seen it yet.
Well, thanks. And with that, let's get started. And Byron, you want to take us through the first few slides?
Sure. Let's start with the 10 surprises. I'm not going to bore you with each of them, but I will point out a couple of them. First, I think China played a major role in stepping up the sanctions and getting Kim Jong-un and Donald Trump to meet in Singapore. And Donald Trump had only one objective in that meeting, and that was to return to the United States and say we weren't going to war with North Korea. And he achieved that. He's criticized because he didn't get them to back down from their nuclear development program or have any surveillance procedures, but all he wanted was to prevent war. The second one worth commenting on is that the dollar has come to life. And we couldn't figure out why it wasn't coming to life earlier, because our interest rates are higher than they are in any other major industrialized country. And we figured that people would flock into the U.S. currency. But that wasn't the way it was in the first quarter of the year. Now the dollar is showing some strength, and that has some negative implications for earnings. The third one worth commenting on is the market did have a 10% correction in February, but I didn't think it did enough damage to psychology, so I still think we're subject to another downdraft between now and the year. Probably the big hit among the 10 surprises this year is that oil has moved up from about 60 to 74, and I think it's on its way to 80. On page 2 here, I don't think we're going to get to a 4% 10-year, but I do think we'll go back up above 3. I do think we'll sign some form of a modified NAFTA agreement, but we pulled out of the Iran agreement, so I was wrong about that. I'm not quite as sure as most people seem to be that the Democrats are going to take over the House. If the economy is doing as well as it's doing, I think people are going to credit Trump with having turned the economy around and brought us to 3% growth rather than 2%. And I don't think they're going to vote for as many Democrats as the consensus seems to think. And China is slowing down, and I hope it's to deal with their non-performing loans. This is our radical asset allocation. We made one change in this since the last quarter. We reduced Europe from 10% to 5%, and we added it to cash. The reason it's radical is that the 15% that we have in fixed income is not in conventional bonds. It's in high yield bonds, mortgages, leverage loans, mezzanine financing, and some emerging market debt. This is basically an all equity portfolio. Why? Because we think interest rates are trending higher and you'll lose money in the market price of whatever sovereign debt you own. So we own no treasuries, no British gilts, no German bunds. Inward thinking takes over. That's the big theme that we're following. We think there's too much inward thinking, and it's available to you in the stock market, in the geopolitical arena, and in the economic outlook. This just shows tariffs. You know, back at the beginning of the 20th century, tariffs were over 30%. And even in the Smoot-Hawley period in the 1930s, they dipped back up to close to 20%. But now they're hovering between 0 and 5%. And the fear is that with the trade war that's being discussed, they go back up to 10 or 20%. I hope that doesn't happen, but I think there's more risk that it could happen than the market perceives. I'm still focused on inequality. I still think it's a major problem in the United States, and it has economic and political implications. This shows the Gini coefficient going around the world. For those of you who are unfamiliar with Gini, it's a concept where if you have a Gini coefficient of 1, that means everybody in a country has the same income. And if you have a Gini coefficient of 100, that means one person has all the money. So you want to have the lowest Gini coefficient you can have in order to show that inequality isn't a problem. So take a look at this. Where are the Gini coefficients low? They're low in Sweden, Finland, Norway, and Denmark. Somehow, if you don't have much daylight during the winter, you tend to have more equality. I don't know if there's a causal relationship there, but there sure is a correlation. On the other hand, if life is pretty good, as it is in England, the United Kingdom, in Italy, and the United States, you have a relatively high Gini coefficient. Now, what can we do to solve it? I don't think we can reverse it. I think the only thing you can do is improve the economy and have the bottom 50% earn more income. Raising the minimum wage would be one way to do that. But the world changed in 1980 when globalization and technology took over. And as the economy prospered, the people in the top 1% did disproportionately better. In the economy I see going forward, I think the top 1% will continue to benefit. So you can't redistribute that. But what you can do is raise the economic opportunity for people in the bottom 50%. And that's the only way you'll reduce this problem. We reduced our position in Europe because we thought that the economy in Europe was going to slow down. It's slowing down because of some natural forces on the continent, but it could also slow down seriously because of a trade war and because the UK is no longer a part of the European Union. At any rate, I think we're glad we made that change. Now, we know as a result of the tax cuts that the administration has passed in legislation, that the budget deficit is going up from about 700 billion this year to over $1 trillion next year or the year after. So we're going to be borrowing more money. Who are the big lenders? The big owners of Treasury securities are the Federal Reserve, China, and Japan. We know because of the trade dispute that China and Japan are going to be less likely to buy our bonds. So in a time when we're going to be borrowing more money, 2 of the 3 principal buyers are going to be buying fewer bonds. And you would think that interest rates would rise. Well, they have gone up somewhat, but while they hit 313, they're back down to 285 now. Why is that? I think one of the key reasons is that we produced so much liquidity in the 2008 to 2015 period and some of that liquidity is looking for a place to hide, and so it's going into the bond market. I don't think the drop back in rates is indicative of a slowing of the economy. As far as we can see, we're still on a 3% growth path. Now here is something we're thinking about a lot and worrying about, and we don't see much attention paid to it in the press. What this shows is how much GDP growth do you get when you add $1 of debt. So in the 1950s, if you put on $1 of debt, you got 73 cents of GDP growth. In the next decade, 66, then 59. And then in the decade of the 80s, it dropped to 34. And it hovered around there during the 90s. And then in the decade of technology, where the internet and the smartphone came into being, it dropped to 17. You put on $1 of debt and you only got 17 cents of growth. You would have thought that you get more growth, but you didn't because we made heavy capital investments. Then it went back to a more normalized level of 36 cents. But if it takes $3 of debt to produce $1 of GDP, and we want to reduce that debt, I think as long as we want to have growth, and it's antithetical to not increasing debt. So we have to expect that debt is going to be rising if GDP is going to be rising. Now this talks about inflation. We've been pretty complacent about inflation. We haven't seen much of it. And that was a situation that was very similar to the 1960s. But remember, at the end of the 1960s, inflation soared, and it took Paul Volcker coming in as Federal Reserve Chairman and rapidly raising the federal funds rate. And you can see that in the yellow line because inflation was rising rapidly at that point, and only by trying to choke it off with higher short-term interest rates were we able to bring inflation down again. So Volcker deserves the credit for that. And the reason we've got this chart is that we're wary that while inflation has been tamed so far, we don't want it to accelerate from here. So we're keeping an eye on it. This is the crowd sentiment poll. We usually have that earlier in the presentation. You can see that in January, it got higher than it ever had been before, almost 80 on this index. Then it dropped into neutral territory, and now it's back up into optimism, but not the extreme optimism we saw in January. But I still think we're likely to have a further correction. Joe, why don't you take over and tell us a little bit about what's going on in the economy?
Sure, thanks, Byron. And the next few slides are going to be about our outlook for GDP growth for the remainder of this year and beyond. And this first slide looks at U.S. GDP growth basically in the post-war period from the 1960s on. And what you can see is that historically the economy was able to grow at about 3% per year. But that broke down in the year 2008, 2009, where GDP growth fell to in the mid 2%. And so you can see that we've really been running well below our historic average for much of the last decade, but we do think that's going to turn around. We expect faster GDP growth this quarter, but also through the remainder of 2018 and probably even beyond as we enter this last leg of the economic cycle. The next chart, really just a lot of lines on this chart, but I would focus you on the second and third ones. And what it basically argues is that over time, GDP growth is really just the combination of the growth in productivity as well as the growth in population. And for most of that post-war period, both productivity and population were growing at about 1.5%, 1.5% to 2% per year. You add them together, you get your 3.5% GDP growth. Everybody's happy. Well, that broke down about, say, call it 8 to 10 years ago. And now, for the last few years, they've both been running below 1%. You add them together, that's your 2% GDP growth that we've gotten. We think productivity is going to start to pick up. We think CapEx could be a driver of that, so we are more optimistic. But this chart really calls into question, what should the long-term trajectory of the U.S. economy be? And it argues that unless one of the two, productivity or population, is to change in a secular way, in other words, revert back to that long-term trend, our natural growth trajectory could be lower than what we've experienced through much of the post-war period. Now, as I mentioned, we think the economy is going to grow faster. Here's a really neat chart that looks at the correlation or the relationship between small business sales growth and GDP. And you can see that small businesses are pretty optimistic now, and that with their optimism, we should see a lift in GDP growth. This next chart is leading economic indicators. And there are two things I'd point out on this chart is that, number one, they continue to move higher. But number two, there's a pretty good relationship between LEIs and recessions. When LEIs roll over, historically, you're about 22 months away from a recession. Our view is that this economic cycle is going to last a lot longer than people think. Our view is that we won't have a recession until at least the year 2021, might even be after that. A lot of consensus today is calling for a recession in 2020 or maybe even late 2019. But our view is that these leading indicators, this and the next few charts I'll show, still indicate that we do have a long time before we will run out of steam in this cycle. Two things to look at this chart. Again, these are long-term charts. These are things that we would encourage you to have on your radar in order to help to understand when the cycle might be coming to an end. And the first thing I'd point out here is the aquamarine line. That's aquamarine, right, Byron? This is one that Byron had to teach me. I didn't have this crayon in my Crayola box when I was growing up. We make these charts, we give them to publishing, they come back in funky colors. So here we're featuring aquamarine and magenta. Both of those I had to Google, by the way. But the aquamarine line is looking at average hourly earnings. And what it tells us is that historically, they don't become a problem until they start to increase at about 2.7%, or until they increase at about 4% per year. That's normally correlated with stronger inflation, as well as more aggressive Fed tightening. And today, average hourly earnings is rising at about 2.7%. If you look at the relationship between unemployment and average hourly earnings, what you see over time is that when unemployment is as low as it is today, say around 4%, that normally correlates with average hourly earnings rising at about 5% or higher. And conversely, when average hourly earnings are at these levels, 2.7%, it normally correlates to unemployment of about 6%. But with average hourly earnings being as low as they are today, it tells us that we do have a long time to go before the economy is going to overheat and the Fed has to hike more aggressively. The second thing to point out on this chart is the yield curve. And historically, the yield curve ends up being the best predictor of business and economic cycles. It doesn't become a problem until after it inverts. And once the yield curve inverts, data tells us you have 12 to 18 months before your next recession. Now, a lot of people are concerned because the yield curve is flat today. The spread between the 10-year and 2-year Treasury is around 30 basis points. But what I would point out is we've seen that before. In the mid-1990s, beginning in, say, 1995 to 1998 or 99, the yield curve is 30 basis points or tighter, and yet the economy ripped. Growth averaged 3.8% per year over those years, and equity markets were quite strong. So a flat yield curve is not necessarily a warning sign. It's only after the yield curve inverts that becomes a problem. But again, the bigger message here is that we're nowhere close to that happening. We still think we have a long time. Likewise, the U.S. consumer is in great shape. What this chart is looking at is, in the background, disposable personal income. That's the right-hand scale. And the line, the blue line, is looking at household debt service as a percent of overall disposable income. And what it shows is the benefit of very, very low rates. The fact that consumers have been able to pile on mortgage debt, credit card debt, a lot of other types of debt, but yet thanks to low rates, the debt service as a percent of that disposable income is very low, suggests that the consumer is still, I think, in very, very good shape. You couple that with terrific employment numbers that we have today, and it tells us that the services, the consumer sector of the U.S. economy, I think still is got a long way to go. In terms of the last leg of this cycle, and call it whether we're in the 5th inning or 6th inning, wherever we are in this economic cycle, I think the next few innings or the last part of it is really going to be dominated by a CapEx story. And what this chart looks at is a correlation between companies' CapEx plans and actual spending. And there tends to be a pretty tight correlation, a pretty tight relationship. It's about 0.74. That tells you that when companies announce they're going to do CapEx, they're generally following through with it. And that's important because we've seen companies do just about everything else with their corporate cash through the course of this cycle other than investing for growth. They've done M&A, they've done share buybacks, they've increased dividends. But what we're beginning to see as the economy is accelerating is that delivery times are backing up. And what this chart looks at is ISM delivery times, and it shows that we're seeing bottlenecks in terms of getting parts to the manufacturers. So I think the bottlenecks in manufacturing is going to end up driving a big CapEx cycle. In the first quarter, S&P 500 companies increased their CapEx about 24% year over year, and we think it's going to continue. Not only are we seeing growth accelerate, we're seeing these delivery times get delayed, we're seeing labor shortages where companies are getting pretty desperate to hire people, and we have very old equipment. If you look at the average age of equipment used in the plants that manufacture or produce the goods and services that are consumed in the U.S., the average age today is 23 years. That's older than any time since the 1960s. So what that means is, on average, the machines or the equipment in factories today was purchased in 1995. If you think about it, what were we doing in 1995? Windows 95 was just coming online. Will Smith was still the Fresh Prince of Bel-Air, and Hootie and the Blowfish was out with like a #1 album. And that was when the average piece of equipment in a U.S. factory was purchased. So we think that companies are going to have to upgrade their equipment in order to meet the new and accelerating demand. This next chart looks at our rates, and as Byron mentioned, our view is that the 10-year Treasury yield is going to go higher, but there's a ceiling on the 10-year Treasury, and I think this chart really demonstrates why that ceiling exists, because about 72% of all sovereign debt out there, over $37 trillion worth of sovereign debt, is at yields of 2% or lower. That means that there's a tremendous appetite for our debt. And as much as inflation and accelerating growth will tend to push up the yield on a 10-year Treasury, the fact that rates are low all around the world is probably going to keep it contained. We think the 10-year should go above 3%. We think it could hit 3.25% or higher, as we are producing more debt, due to budget deficits and things like that. But it means that the 10-year Treasury is not going to get nearly as high as it should, simply because we have low rates just about everywhere else. And with that, Byron, I'll turn things back over to you for your view on oil.
Okay. Well, as I said, when I went through the 10 surprises, one of our most out of consensus calls was the price of West Texas Intermediate would go to $80. And one of the reasons for it was that we thought that the spare capacity in the OPEC countries was down to a worrisome level. We also thought that production out of Iran and Iraq and Venezuela would decline because of political problems there. And so while the world oil supply was declining, world demand, because of 3%, or throughout the world, 3.9%, 3% growth in the U.S., 3.9% worldwide because of China and India. We thought there'd be more demand for oil and less supply. We thought the price would go up, and it has. And we don't think it's through going up. We're still holding to our view that it'll get to 80. Everybody's worried about tariffs, and I think they should be, but so far the numbers are pretty small. I mean, we have $200 billion worth of tax cuts. We're increasing spending by $100 billion, and we're repatriating $500 billion in overseas profits. So the numbers in the legislation that's been passed are much higher than the tariffs. So there's more fiscal stimulus than there is tariff drawdown. We'll see how far the tariffs go. But so far, the economy is responding to the fiscal stimulus, and that's why we're growing at 3%. And you can see, where are the problems? Well, our trade deficit with Mexico, with Canada, and basically with Japan aren't too severe. But we're shipping $130 billion worth of U.S. goods to China, and we're buying $505 billion worth of stuff from them. So if we get into an all-out trade war, there are going to be a lot of goods, and there's a difference between what we're shipping. We're shipping finished goods, and we're buying component parts. So if we can't get the component parts, or if the cost of the component parts rises sharply, that's going to have an impact on the U.S. economy. In terms of who's going to win in November, it really looks like the Democrats have a lead in the House. But as I said earlier, I'm worried that the strong pace of the economy is going to make these numbers shrink somewhat. As far as the Senate is concerned, it looks like the Republicans are in a very secure position. I've had a chance to talk about these ratios with a number of leading politicians, and the Democrats, of course, are very confident that they're going to take the House, and they think they even have a shot at the Senate, but I'm not so sure. Just looking at what impact the election has, usually after the election, almost everything does well. The midterms are usually good for the S&P 500. 6 months later, they rise 13%. Defensive goes up 9%. Cyclicals 13%. Investment grade bonds up 2%. And high yield up 9%. And we're already seeing it in the high yield market. So, the market may flutter around before the election, but regardless of how the election turns out, I think the markets will be stronger between the beginning of November and year end. One curiosity that Joe and I are fascinated by is the fact that the dollar tends to vary with the presidential approval rating. This isn't just true with Trump, it was true for Obama as well. And when Obama's approval rating was declining, so was the dollar. And with the improvement in Trump's approval rating, the dollar gained strength. And right now, the dollar is gaining strength because the approval rating is going up. I don't know if there's a causal relationship or just a correlation, but it's worth following. This is the dividend discount model that I've talked about before, and it's really working pretty well in this environment. For those of you who've seen previous webinars, you know that down the left-hand scale, the y-axis, we have various earnings levels for the S&P 500. Across the top, various interest rates for the 10-year U.S. Treasury. The concept of the model is if you know what the S&P is going to earn and you know what the 10-year Treasury is going to yield, then you can determine the equilibrium point where bonds and stocks are equally attractive. So we're using 160 for S&P earnings for 2018, and the 10-year Treasury is, let's say, at the midpoint between 2.75 and 3%. So if you go across the 160 line, you get a market that's somewhere between 3,000 and 2,700, and the market is about 2,800. So the model is working. Why is this useful? Well, if interest rates go to 3.5%, then the equilibrium point drops to 20. If it goes to 3.25, the equilibrium drops to 2,700. If it goes to to 24. At 3.25, it drops to 24.35. At 3.5, it drops to 22.32. So that would be a pretty severe setback. But by that time, we might be looking at next year's earnings, which are likely to be 170, and that would dampen the fall. At any rate, keep this chart handy, refer to it as the market opens each day, and see whether the interrelationship between stock prices, interest rates, and earnings continues to hold true. This is not a predictive tool. It's a tool that will help you understand when the market gets overvalued or undervalued. In terms of global share prices, as Joe said earlier, earnings are the key, and we still think year-over-year comparisons are going to be about 20% increases. But next year, in 2019, the comparisons are going to be less favorable. Joe, you want to take it over from here?
Sure. And what this next chart looks at is how the market performs during Fed hike cycles. And there's a lot of questions to at what point are higher rates going to cause pain for the equity market? And what this table at the bottom of the chart argues is that really the market peaks generally after the Fed has hiked. So, as the Fed is hiking, equities continue to do fairly well. Obviously, higher rates is going to be negative for valuation, but typically the reason why the Fed is hiking is because the economy is accelerating. That's exactly the environment we're in today. We think the economy is going to accelerate. It's going to force the Fed to hike more and more and more, but we think equities can continue to outperform. But as Byron said, 2019 does become much trickier because those year-over-year comps are going to drop to probably low to mid or mid to high single digits. In other words, the first quarter of 2019, the year-over-year comps are going to be incredibly difficult because they'll be looking back on earnings from the first quarter of 2018 where you had growth accelerating and you also had the benefit of tax cuts. But nevertheless, this chart argues that the market doesn't really peak until around the time or after the Fed finishes hiking. We think they still have a ways to go. Just turning to our global outlook for the next couple slides, what this chart highlights is that global growth overall is pretty strong. The IMF is forecasting global growth to be about 3.9% in 2018. They've raised their growth forecast or targets a couple times over the last year, responding to growth. And the biggest drivers here are coming from China and India. India is growing at the mid 7.4%. And China, even though it's deliberately slowing its economy in our view, is still able to post growth in the mid 6% range. Our view is, as Byron mentioned earlier, that China's slowdown is good. It's healthy because it is an attempt to take on their non-performing loans in order to shore up their banking, especially the shadow banking side of their economy. And overall, that's going to make their economy less cyclical, less prone to the extreme highs and lows that they've experienced over the last couple decades. So overall, it might be a slower trajectory, but we think it's a higher trajectory. Growth in Europe, as we've mentioned, we think is slowing. But even in places like Japan, we think they're going to be able to pull off growth that's going to be closer to 2% going forward, and for reasons that we'll highlight in a minute. This is looking at China's manufacturing PMIs. I mentioned just a second ago, they are slowing their economy. Their purchasing managers index had been running in the 55+% range for going back to the early 2000s, but in recent years they've slowed it to the low 50s. And again, we think it's part of that deliberate effort in order to make the economy less cyclical and less reliant on the financial sector. Looking at valuations at global markets, we think outside the U.S. you can get more attractive valuations. In IFA, you can see that we're looking at PEs closer to the 15 range, and then emerging markets, which are growing faster, we do see more attractively valued. And if you look at the two biggest growth stories out of emerging markets, that's China and India, if you add up the public value of their equities in the Morgan Stanley All-Country World Index, ACWI, China's maybe a 3.6% weight. India's got a weight somewhere below 1%. So if you add up the two, they're about 4.5% or so of ACWI. So whether investors are considering the public side of equities or the private side of accessing their economies, in either case, we think that people are underinvested in emerging markets, especially India and China. China's the second largest economy, growing in the mid 6% range. India is the sixth largest economy. It's growing faster, yet the public value of their equities in ACWI is low single digits, and we think that clients are generally underallocated. Just turning to Japan for a second, we think that there is an opportunity for Japan to exit QE, and what this chart looks at is Japanese leading indicators, and they've troughed and even started to leg up a little bit. That is positive for the Japan growth outlook, as there tends to be a pretty tight correlation between their leading indicators and GDP growth. Life lessons, we're not going to go through these today, but for new viewers out there, I just want to make you aware in the slide deck, which you can receive if you want to email us, and I'll provide you an email at the end of the program. There are life lessons. These are written by Byron based on his 50 years experience in the industry, and it's a neat read. I would encourage you to read it. Now, with that, we do have questions that people had submitted via social media. And so, Byron, maybe we'll start with the first couple questions. These were submitted in advance through our Twitter feed, etc. And the first question, Byron, if I could read this here, it says, until recently, it looked like this trade flare-up would remain just that. But with recent developments, including press rumors about the potential withdrawal from parts of the WTO, how likely is it that trade concerns lead to an early recession?
Well, the economy has a tremendous amount of momentum now. If this thing escalates, it involves Europe and China, and the numbers approach $1 trillion. That's 5% of GDP. That's a pretty big number. So we've got right now, I would say the market is going up every day and is saying somehow the various countries that are talking in hostile terms toward each other, they'll back down from it. My feeling is the market is too complacent about trade and about the tariffs. But we'll see whether that sort of develops. I think that it won't be as severe as being threatened, but it won't be as benign as investors think.
Right, and I think it's worth mentioning that last week the first round of the Section 301 tariffs were put into play. And, hopefully all of you watching had a chance to go and order your retreaded tires, your offset printing machines, as well as nuclear reactors, because evidently they did get more expensive. If you're trying to order those on Amazon Prime, it's worth noting that nuclear reactors are not eligible for free shipping, for what it's worth. But, the point is, I think a lot of people are looking at trade thinking that this is binary, right? The U.S. announces tariffs under Section 301, and then we sit back and we tally up the amounts that China and other countries are going to, the amount of tariffs they're going to put on our goods. But I think the point you had made a little bit earlier was that the U.S. tends to import a lot of components, whereas we sell a lot of finished goods. So I think for markets and for companies, it means that at best these tariffs are going to be inflationary because it's going to push the component prices up for a lot of things that the U.S. is going to be consuming. And at worst, there are examples in history. If you look at things like the Smoot-Hawley tariffs, that was in an environment where it started off as tariffs against 800 imported goods, principally to protect our sugar industry against cheaper Cuban sugar imports. That was in 1929, 1930. So it started off with tariffs against 800 imported goods, but it ended with tariffs against 20,000 imported goods. Basically, everything that moved was taxed, and trade ground to a halt. So I think there is reason to be concerned, and the point that I would make on trade here is that it's not exactly binary. It's not simply just, $50 billion here versus $50 billion there, because there are knock-on effects because of how global and interconnected our supply chain is. I think the risk here is greater inflationary pressure.
And the important thing is that the risk is greater than the market is sensitive to. And so that's one of the reasons why there might be a pullback between now and year end, even though we're optimistic that the S&P 500 will end the year around 3,000.
Yep. And another trade question, Byron. The question reads, the assumption for many years was that the global free trade regime would fuel China's rise to the world's largest economy. Whatever anyone thinks of Trump's trade policy, will it be effective at combating China's economic rise?
I think China is determined to be the largest economy in the world. By 2025, they hope to be self-sufficient and not be dependent on importing technology. By next year, they'll be spending more money on research and development than we are. I think by 2025, they'll be the leader in digital technology, biotechnology, and agricultural technology. So I think they're on a track to be the world's largest economy. They already are on a purchasing power parity basis. By 2035, they'll be the largest economy on a GDP basis. So I think that the trade conflict can slow that down, but I think its direction is inexorable.
Right. It's worth mentioning that China has a middle income problem, and the way that they are trying to solve for that is by being the technological leader in the world. And if you think about the middle income problem, it's basically an argument that says it's relatively easy for countries to lift their population from low income to middle income, but it's very hard to go from middle income to high income. So China's in a position where it lifted 400 million people from low to middle income, and they know that they're not going to be able to take the next step through low-cost manufacturing. They need to do it through innovation. So you hear Made in China 2025, and those policies are really designed to innovate and to push China's technological leadership. You hear about the One Belt, One Road initiative. Again, same thing. It's ordered to try to solve for that middle income problem to move from middle to high income. So it's really core to their policies. Next question, Byron. What do you anticipate will come of the president's upcoming summit with Vladimir Putin? How would a better relationship potentially benefit the economies of U.S., Europe, and Russia?
Well, look, I think a hostile relationship with anyone is not good news for the economy. Russia is very dependent on oil for its economic health. I think it would be in the best interest of Russia to have a more open trade policy with the U.S., and it would be a good thing for the U.S. for Russia not to be taking unilateral military action in the Mideast or in Eastern Europe. So hopefully we'll begin a dialogue and loosen the tensions, but I don't think we'll agree on anything very specific from those talks or the NATO talks that are going to take place over the next week.
Mm-hmm. Well, thanks. The next question is, we're halfway through the year. Which of your 10 surprises do you feel most confident about? Which do you feel least confident about?
Oh, well, I feel most confident about S&P 3000. I'm feeling pretty confident about oil West Texas at 80. I'm a little nervous about the Democrats taking the House because of economic reasons. So that gives you a glimpse of my degree of conviction and insecurity.
Well, thank you. And the last question here, This actually has to do with the midterm election. It says the next webcast will have a much better sense of where the polls stand heading into the midterm elections. What should investors be most focused on in the coming months as they think about the role the new Congress might play in everything from trade to healthcare?
I think earnings are going to determine the course of stock prices. So where do I think the biggest earnings gains are going to be? I think they're going to be in technology, in biotechnology, in energy, and in cyclical areas. I don't think, I'm not particularly positive about consumer staples. I'm not positive even about consumer durables. I am positive about industrials and materials because I think there'll be more inflation.
Yeah.
So that gives you a list of something to buy between now and year end. But I would take a long-term view. I think the most important non-consensus view that we have is that the next recession is not going to occur until 2021. And the mitigating factor of that is that earnings comparisons in 2019 will not be as favorable as they were in 2018. And that'll have an effect on overall market performance, particularly if interest rates are rising and multiples are contracting.
Yep, goes back to our second quarter webinar, which is entitled Triumphant Equity Returns Are Over. Well, with that, thank you, Byron, and thanks again for everyone who tuned in with us today. And lastly, if there are questions we didn't get to, or if there are other concerns or feedback, please let us know at Byron Wien's Commentary at blackstone.com. Thank you.